Thanks for clicking. All eyes were on the Bank of Canada's interest rate announcement this morning, with the majority of economists expecting the bank to keep its word and maintain its pause on interest rate hikes. We got our answer at 10 a.m. this morning, and the bank did not disappoint, opting to maintain its policy rate at 4.5%.
You are getting a once-in-a-lifetime, very lucrative opportunity.
And the move by the bank was widely expected, not only because going back on its word so soon after announcing its pause would lose the bank almost all credibility, but also due to mounting data showing that Canada's inflation rate is indeed coming down. With that said, there is a growing concern out there, which we've talked about before on this channel, that even though Canada's inflation rate might be coming down, the bank may be forced to raise rates as a result of higher rates in the US. And this concern was only amplified yesterday when U.S. Fed Chair Powell said that the U.S. may have to raise rates higher, and the value of the loonie subsequently plunged. So what I want to do today is go over the bank's interest rate announcement, take a look at what's been happening to the loonie and why, and then discuss what to look for next. Speaking of next, Deputy Bank of Canada Governor Carolyn Rogers is set to speak and take questions tomorrow, and she'll no doubt be addressing both the interest rate announcement and the effect of higher rates in the U.S. on our loonie. We'll obviously have an update out on that speech on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this announcement. As mentioned, the Bank of Canada made its interest rate announcement this morning, holding to its word and keeping its pause on interest rate hikes. The bank noted lower than expected economic growth in the fourth quarter as its rationale for maintaining its pause. More important, however, is that it also maintained its stance on a conditional pause, noting that it will continue to assess economic developments as they unfold and is prepared to raise the policy rate if the direction of inflation warrants it. So, the bank did maintain its pause on interest rate hikes, noted a weakening economy and a slowing of the inflation rate, but did leave the door open for further rate hikes should the economy or the inflation rate warrant it.
It won't. Trust me.
And although the bank did maintain its much anticipated pause on interest rate hikes, it's not clear as of yet how long the bank will be able to maintain a divergent path from the U.S. Federal Reserve. The value of the loonie fell to its lowest level since November yesterday, following testimony on behalf of Fed Chair Powell on the news that the Fed is not only considering further interest rate hikes.
The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated,
but also considering accelerating the pace of those hikes.
If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
The comments from Powell echo that of Fed Governor Christopher Waller, who said just a few days prior that the Fed's target rate could go higher than 5.4%. So according to the comments coming from Fed Chair Powell and Fed Governor Waller, the Federal Reserve could very well go over 5.5%. which could be a real problem for the Bank of Canada, even if our inflation rate continues to come down. Most economists are now arguing that the bank can only allow the spread between its policy rate and the U.S. Fed funds rate reach 100 basis points before we start to see real problems in Canada. According to Derek Holt, head of capital markets at Scotiabank, if the Bank of Canada allows the spread between the Fed's rate and our own to widen too much, they risk the currency tumbling. Holt then went on to say that the loonie has already depreciated by enough on a real effective exchange rate basis to be of a concern to import price pass-through effects and inflation expectations. So what Holt is saying is that with the loonie's depreciation that we've already seen, imports are getting more expensive. And when imports get more expensive, inflation can and will go up. And we're seeing the continued devaluation of the loonie whenever it looks like the Federal Reserve is going to have to raise rates. Earlier on in the month, when better than expected job numbers came out of the US, we saw the value of the loonie go down, and we all saw the loonie sink yesterday on Powell's testimony. So, when the Fed raises rates and the Bank of Canada doesn't, the value of our currency goes down. But why is this happening?
He's the boss.
When the US raises interest rates higher than that of Canada's, the amount of money that can be made off of US dollar debt also increases. And as such, so too does demand for US dollars. And when demand for dollars increases without a corresponding increase in supply, so too does its value. At the same time, the amount of money that can be made off of Canadian dollar debt decreases, which decreases demand for Canadian dollars, and as with any good, as demand for it decreases, so too does its value. So if the spread between US interest rates and Canadian interest rates gets too far, if that gap widens too much, more than the 100 basis points that's being predicted by a lot of economists, maybe even smaller than that, then we could see more pressure put on the Bank of Canada to raise interest rates to narrow that gap. As if they fail to do so and our loonie continues to depreciate, that will make the price of imports even more expensive, which will put more upward pressure on our inflation rate, which will lead to higher interest rates in the future anyways. So, the Bank of Canada could very well be forced to raise interest rates even higher, which, given the weakening of our economy, which we've talked about on this channel and was referenced in the Bank of Canada's own interest rate announcement this morning, is not exactly a good sign. With that said, we will continue to track the Bank of Canada and its policies' effect on the Canadian economy and real estate on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.